Friends, thank you for being here today. In 1929, the world discovered just how quickly prosperity can transform into panic. One moment, Wall Street seemed invincible. The next, it was in shambles. Fortunes disappeared in a single night. Banks bolted their doors shut. Millions of people lost absolutely everything. The common belief is that this was a singular catastrophe, a sorrowful chapter that concluded nearly a century ago. What if I told you that the final chapter of that story was never actually written and that we are all living in its unwritten epilogue? What if the very same dynamics that triggered the Great Depression are subtly molding your world at this very moment? If you have ever found yourself questioning why prices consistently climb, why home ownership seems unattainable, or why debt continues to expand more rapidly than incomes, you are certainly not the only one. The events unfolding around you are not accidental. They are the reverberation of a system constructed upon risk, greed, and a grand illusion. The world was caught in a wave of elation. Stock prices were climbing to unprecedented heights. Ordinary individuals, teachers, farmers, and mechanics were purchasing shares on margin, taking out loans to wager on a market that appeared to only ever increase. Newspapers heralded it as the dawn of a new era of wealth. Does that ring a bell? A widespread conviction held that the old principles no longer applied. Technology was advancing rapidly. Credit was readily available, and politicians vowed perpetual growth. Meanwhile, behind the curtain, an identical pattern was taking shape, debt being piled upon more debt, with only confidence serving as the adhesive holding the entire structure together. In the years that preceded the crash, speculative fever was not confined to the stock market. The real estate market was booming, banks were lending with reckless abandon, corporations were inflating their profit reports, and consumers were acquiring luxury items through installment plans. It was a culture of optimism erected upon borrowed funds. And much like every debt driven celebration in history, it concluded in the exact same manner. Abruptly, in October of 1929, as alarms spread like wildfire, investors scrambled to sell off their holdings, prices plummeted. In a matter of days, billions in theoretical wealth evaporated. The system that had once appeared so formidable cracked wide open, exposing a completely hollow interior. However, this is the crucial element for today. The crash itself was not the origin of the Great Depression, it was merely the symptom. The more profound affliction was the very framework of the economy. There was an excessive amount of debt, an insufficient amount of real income, and an overabundance of faith in perpetually rising markets. Sound familiar once more? Today, we are witnessing the same of circumstances unfolding, albeit under different labels. Instead of ticker tape and telegrams, we have trading applications and cryptocurrency charts. In place of margin loans, we have credit cards, mortgages, and deficits in the trillions of dollars. And the illusion is more potent than ever before. Modern economies are fueled by consumption, but consumption hinges on confidence, and confidence is a delicate thing. When individuals trust that the system is secure, they borrow, they spend, and they invest. The moment they begin to doubt it, everything grinds to a halt. That is precisely what occurred in 1929, and it is the scenario that economists are apprehensive about today. The genuine threat is not a market crash itself, but rather what ensues when trust completely vanishes. Because when nobody believes the system can endure, they cease to participate in the game. In 1929, household debt in the United States had climbed to levels never seen before. People were purchasing automobiles, radios, and homes they could not genuinely afford under the assumption that their wages and asset prices would continue to rise indefinitely. In 2025, the total global debt exceeds 300% of the entire world's gross domestic product. The fundamental pattern remains unchanged. We are still utilizing tomorrow's earnings to finance our lives today. During that era, banks peddled hazardous loans masked as grand opportunities. Today, they engage in the same practice using intricate financial instruments. The tools may have changed, but the underlying psychology has not. During the 1920s, wealth inequality reached historical peaks. A tiny fraction of elites held control over most of the country's wealth. Meanwhile, the working class managed to get by on credit and hope. When the bubble finally burst, they had no safety net to rely on. Now, consider the present situation. The top 1% of the population possesses more wealth than the bottom 90% combined. Corporate profits are setting new records while wages remain flat. The middle class is being squeezed, resorting to debt to bridge the financial gap. It is the same narrative, simply updated for a new century. In the late 1920s, the Federal Reserve maintained low interest rates to stimulate growth, only to increase them sharply when inflation started to emerge. The consequence was a sudden shortage of liquidity that constricted credit markets and ignited panic. Today's central banks are caught in the same predicament. Should they create more money to sustain the markets, or should they raise rates to control inflation, knowing full well that either decision will have significant repercussions? History is replaying itself in slow motion. And then we have the element of speculation. In 1929, people invested their life savings into stocks they had little understanding of simply because everyone else was doing it. Today, the phenomena are meme stocks, non fungible tokens, and cryptocurrency bubbles. The psychology is precisely the same, driven by the fear of missing out, greed, and the belief in a path to effortless wealth. When prices are on the rise, people convince themselves they are intelligent. When prices fall, they come to the realization they were merely fortunate. The Great Depression brought to light a single uncomfortable truth: when systems become excessively unequal and overly leveraged, they inevitably collapse under their own weight. The question is not a matter of if, but of when. And to be frank, the majority of the world's economies today are operating on borrowed confidence. The warning signs are all present: record levels of household debt, an increase in corporate defaults, and governments printing money at a faster rate than ever before. Yet, there is one crucial distinction. In 1929, the financial system was considerably smaller. When it collapsed, it brought ruin to millions. Today, The system is global. A shock in one nation can send ripples across continents in a matter of seconds. This raises the stakes to a much higher level. What transpired in 1929 was not merely a financial failure, it was a failure of imagination. People had come to believe that prosperity was a permanent state of affairs. They were unable to perceive the fragility of the system. We are making the same mistake today, placing our trust in central banks and politicians to maintain stability in all things. But stability that is constructed upon debt and speculation is not genuine. It is merely borrowed time. The lesson from 1929 was not truly learned, it was forgotten. This is because each new generation believes it is more intelligent than the one that came before it, convinced that they have engineered a more secure system and that this time is different. However, the recurring patterns suggest otherwise. The Great Depression began with a few tumultuous days on Wall Street, but it concluded with years of hardship, deflation, and a complete loss of trust. The danger does not lie in history repeating itself, it lies in us repeating history. And if the same forces are indeed at play again, the question then becomes what will happen when the illusion shatters once more? By the early 1930s, the illusion had been completely shattered. Bread lines wrapped around city blocks, banks were failing by the thousands. Families lost their homes, their life savings, and their sense of hope. What started as a financial panic had escalated into a comprehensive social crisis. Governments made frantic attempts to respond, but their methods were clumsy. They reduced spending to balance their budgets. They implemented higher tariffs to safeguard domestic industries, and they stood by as unemployment rates soared. In their anxiety over short term instability, they inadvertently made the collapse even more severe. The Great Depression evolved into a decade long affliction, one that fundamentally altered politics, economics, and the very faith in the capitalist system. Yet, here lies the unsettling reality. The same kind of logic is apparent today. When fissures start to appear, policymakers resort to the same familiar strategies, printing more money, lowering interest rates, and vowing to maintain stability. They are addressing the symptoms rather than the underlying causes. The global economy is currently afloat on a sea of debt that can never be fully repaid, held together by the interventions of central banks and the public's belief in the system. That belief is exceedingly fragile. When it finally breaks, history does not repeat itself, but it certainly rhymes. Consider the role of speculation. During the 1920s, leverage was the fuel for a widespread mania. Investors were borrowing up to 90% of the value of their stock purchases. When prices experienced even a minor decline, their loans were called in. These margin calls created a domino effect, compelling mass liquidation and setting off a devastating downward spiral. In contemporary markets, leverage is concealed behind layers of complexity. Hedge funds, derivatives, and shadow banking institutions can amplify small shocks into threats to the entire system. The mechanisms have become more sophisticated, but the fundamental danger has not changed. Too much risk, not enough transparency. and an excessive amount of confidence in models that are built on flawed assumptions. When the real world deviates from these assumptions, the models implode. During the Great Depression, trust disintegrated first in the markets and subsequently in the institutions. Banks would shut their doors without warning, leaving their depositors with absolutely nothing. In reaction, the United States government established the Federal Deposit Insurance Corporation to guarantee deposits. This measure was effective for a period, but the scale of today's financial world is vastly different. Banking is now a global enterprise. When Silicon Valley Bank failed in the year 2023, panic spread across international borders almost instantaneously. The same dread of unseen losses and the disappearance of safety still lurks just beneath the surface. What rendered 1929 so perilous was not just financial, it was psychological. The belief in perpetual progress had transformed into a kind of religion. Prosperity was seen as destiny. When that myth was shattered, people did not just lose their money, they lost their faith in the system itself. The danger we face today is analogous. For decades, we have been assured that central banks can manage economic cycles, that policymakers can mitigate downturns, and that recessions are a thing of the past. However, every solution requires more debt, more intervention, and more distortion of the market. Each bailout plants the seeds for the subsequent collapse. The Great Depression also made it clear how interconnected global economies had become. When the American markets tumbled, European banks, which were already weighed down by war debt, also collapsed. Germany was plunged into a severe crisis. That economic collapse fostered resentment, extremism, and political turmoil. The world discovered that economic suffering does not remain localized. Fast forward to the present day. Global debt has surpassed $300 trillion. A crisis in one part of the world, a sovereign nation defaulting on its debt, a currency being devalued, a major bank failing, can send shockwaves through the system instantly. The structure is larger, but it is no more resilient. In 1929, policymakers believed they could restore confidence with speeches and minor interventions. They failed to grasp the nature of the illness. The problem was not panic, it was leverage. People were not behaving irrationally, they were simply overextended. The same principle holds true now. Central banks are inundating markets with liquidity, hoping that optimism will spontaneously regenerate. But liquidity is not the same as solvency. Printing money does not generate real value, it only postpones the acknowledgement of losses. And the longer that acknowledgement is postponed, the more severe the eventual correction will be. Here is another parallel. During the 1920s, asset prices climbed far beyond their fundamental values. Investors rationalized this by asserting that this time is different, claiming that new technologies, new management techniques, and new government policies had rendered the old rules obsolete. Does that sound familiar? Today, valuations are once again stretching the bounds of logic. Companies that lose billions of dollars are trading at all time highs simply because the market anticipates endless growth. The same sense of optimism is blinding investors to the underlying fragility. The names have changed, from RCA and Bethlehem Steel to Tesla and startups with no profits, but the psychology is identical. Debt bubbles always conclude in the same manner. Confidence shatters, credit becomes scarce, and prices fall. The only question is the timing. In 1929, it occurred suddenly. In the modern era, it might happen more gradually, camouflaged by policy interventions. But the laws of arithmetic are immutable. If debt increases faster than income, repayment becomes an impossibility. If growth is dependent on the expansion of credit, then stability is merely an illusion. We are replicating the same framework that condemned the 1920s, but this time on a global scale. Another striking similarity is inequality. Prior to the crash, the gap between the wealthy and the poor was extreme. The rich engaged in stock market speculation, while the poor relied on installment loans to get by. When the crash happened, the losses were distributed unevenly. Today, inequality is even more pronounced. The top 1% of the population owns more than half of the world's wealth. Asset inflation benefits those who already possess assets, while wages remain stagnant. Debt is used to fill the resulting void. The middle class may feel wealthier as home prices increase, but that wealth is built on borrowing. When interest rates rise, the illusion dissipates and the social fabric begins to fray. The Great Depression gave rise to populism and protectionism. People became more insular, directing blame at foreigners, elites, or complex systems they did not comprehend. We are witnessing the same sentiments gaining traction once again: a growing distrust in institutions, anger over inequality, and a fear of change. Economic insecurity is a breeding ground for extremism. History serves as a stark warning of what can happen when economic pain intersects with politics. Back then, governments experimented with austerity, cutting public spending in an attempt to restore confidence. It was a failure. Today, leaders are confronted with the opposite temptation: infinite spending funded by the printing of money. Both approaches ultimately lead to collapse, one through deflation and despair, the other through inflation and decay. Sustainable prosperity demands a balance. Debt should be used to finance production, not speculation. Policies must prioritize long term stability over short term gains. Yet, the incentives within the political system often reward the very opposite. In 1929, speculation was a visible phenomenon. Crowds would congregate outside brokerage firms to watch the tickers. Today, speculation is digital, characterized by instantaneous trades, algorithmic betting, and derivatives layered upon more derivatives. The speed of these transactions amplifies the system's fragility. When market sentiment shifts, there is no time to react. Markets now move faster than human comprehension, a velocity that ensures the next crash, when it arrives, will have spread before most people even realize it has started. Perhaps the most dangerous parallel of all, however, is found in psychology. Before every major collapse, people tend to feel they're safest. They believe in progress, technology, and their ability to control outcomes. They dismiss cautionary voices as mere pessimism. In the 1920s, those who sold their stocks early were ridiculed. In 2025, those who raise concerns about bubbles are met with the same kind of scorn. Confidence creates blind spots and complacency accumulates. Then one day, something inevitably breaks: a major default, a failed auction, a sudden disappearance of liquidity, and the illusion vanishes in an instant. Yet, history is not destiny. The lessons are there for us to learn. Diversify your risk. Question the prevailing consensus. Understand that value is contingent on trust, and trust is contingent on discipline. The system does not fail when markets decline. It fails when people forget why they rose in the first place. In 1929, no one could have imagined a decade long depression. In 2025, few can imagine the same. That is what makes the echo of the past so perilous. Familiarity breeds a dangerous form of blindness. So, as debt continues to accumulate, speculation intensifies, and inequality deepens, you must ask yourself, are we any wiser than those who came before us? Or are we simply repeating their errors with more advanced technology? When the dust finally settled after 1929, it was not just investment portfolios that had been decimated, it was faith. Faith in the market, faith in leadership, and faith in the promise that hard work alone could guarantee prosperity. The collapse compelled nations to reevaluate everything they thought they knew about money and power. The United States remade itself through the New Deal, which introduced financial regulations, deposit insurance, and social safety nets. While these reforms did not end the Depression, they did manage to slow the economic bleeding and establish anew of rules. For the very first time, the state assumed responsibility for ensuring economic stability. However, even those solutions contained the seeds of future vulnerabilities. Once governments discovered they could manipulate markets to maintain stability, they never relinquished that power. Consider our current position. The foundations established in the 1930s continue to influence our present reality. Central banks inject liquidity whenever panic arises. Governments allocate trillions of dollars to boost demand. Investors have come to expect to be rescued. This moral hazard has become a permanent feature of the system. Risk is socialized, while rewards remain privatized. In 1929, such a concept would have been inconceivable. In 2025, it is simply taken for granted. This is how history gradually shifts from emergency interventions to established doctrine. What was once considered exceptional becomes routine. The Depression taught leaders one undeniable lesson: deflation is lethal. When prices fall, people hoard cash, businesses postpone investments, and unemployment spirals out of control. To avert this outcome, modern economies have come to accept inflation as a normal part of the economic landscape. But this tolerance comes at a price. Persistent inflation erodes savings, encourages borrowing, and penalizes financial prudence. It silently transfers wealth upward from savers to borrowers and from workers to the owners of assets. The entire system now relies on this concealed transfer of wealth. It cannot permit prices to fall even when market fundamentals suggest a correction is necessary. This is why crises today typically conclude with bailouts rather than bankruptcies. Back in 1929, markets were smaller and the damage, while substantial, was largely confined to a national level. Today, markets are global. Capital flows traverse the globe in milliseconds. Derivatives create intricate links between banks across continents. A policy error in Washington can ricochet to Frankfurt, Beijing, and Sao Paulo within minutes. The interconnectedness that was designed to propagate prosperity now serves to multiply risk. When a single link in the chain breaks, the contagion spreads instantly. This is why minor crises can now set off global tremors. The structure itself magnifies every shock. The Great Depression also reshaped the geopolitical landscape. Economic collapse fanned the flames of nationalism, protectionism, and conflict. Desperate populations turned to strongmen who promised them certainty. In our own time, the parallels are becoming increasingly sharp. Economic anxiety is giving rise to political extremism, populism is on the ascent, and faith in democratic institutions is waning. When people lose hope in the possibility of fair opportunity, they seek control, any form of control they can find. That was the reality in 1933, and it is the reality now. The original crash was precipitated by the belief that markets could correct themselves. Today, we cling to the belief that governments can always step in to fix the problem. Both of these beliefs are illusions. No system can defy the basic laws of arithmetic. Debt exceeding income, speculation exceeding production, and promises exceeding reality, these imbalances always resolve themselves in the same way. The longer the denial persists, the more severe the eventual reckoning will be. In 1929, few people understood how deeply intertwined the worlds of finance and everyday life had become. A farmer in Kansas did not perceive the connection between Wall Street leverage and the price of wheat. But when credit markets froze, his world fell apart. Today, the connections are far more complex, but they are no less real. When central banks tighten their monetary policy, mortgage rates increase, the housing market cools, and jobs are lost. The feedback loop is faster, and the impact is more profound. It is ordinary people, not algorithms, who bear the cost. Technology has altered the scale of these events, but not their fundamental nature. In the 1920s, ticker tapes disseminated prices with a time lag. Today, algorithms execute trades instantly without any judgment. Fear and greed, once human emotions, have now been automated. This makes modern crises more violent. When machines detect a price drop, they sell. When they sell, others follow suit. Liquidity can vanish in a matter of seconds. What once took weeks to unfold can now happen before the markets even open. The cycle has been compressed, but the consequences remain unchanged. Yet, there is another lesson to be drawn from 1929, one of resilience. Out of the wreckage came reform. Out of despair came innovation. The challenge for our generation is to adapt before a collapse, not in its aftermath. We are aware of the warning signs: unsustainable debt, inflated asset prices, vast inequality, and overconfidence. We are also aware of the solutions: fiscal prudence, productive investment, and shared prosperity. What we lack is the political will. It is always easier to postpone the pain, to borrow another $1 trillion, to print money for another rescue. But every postponement only compounds the severity of the final reckoning. If you examine the events of 1929 closely, one recurring theme emerges: denial. Journalists initially dismissed the market downturns as healthy corrections. Politicians referred to them as temporary turbulence. Bankers insisted that the fundamentals were sound. By the time they acknowledged the truth, it was already too late. The system had already fractured. That same psychology, that refusal to believe what is happening, is timeless. It surrounds us once again. Market optimism remains high, valuations defy gravity, and central banks provide assurances of stability. Yet, beneath the surface, the strain is building. When future historians look back on our era, they will ask the same question we ask of the people of 1929: how could they not have seen it coming? The answer will be the same. They did see it. They simply chose not to believe it. Seeking comfort is easier than making corrections. That is the fundamental lesson of every financial crash. So, where does that leave us? The global economy is teetering on a familiar precipice. Growth is slowing, debt is climbing, inequality is fueling anger, and institutions are under strain. Technology is accelerating everything. The pattern is old, but the context is new. The Great Depression taught us that a collapse is not just a financial event, but also a moral one. When trust erodes, systems crumble. The challenge we face today is to preserve that trust before another reckoning compels us to renew our systems. If you have followed this analysis this far, take a moment to consider your own economy, your savings, the prices you pay, the opportunities available to you. The ghost of 1929 does not reside in history books. It is present in every decision made to chase profit without a solid foundation, to disregard warnings in favor of comfort, and to mistake speculation for genuine growth. Crashes do not materialize out of thin air. They grow quietly within our collective beliefs. So, you must ask yourself, if the conditions of 1929 were to return, would we even notice? Or have we constructed a system so intricate, so self assured, that it is no longer capable of seeing its own reflection? The answer to that question may very well determine whether the next decade repeats the past or finally learns from it. If this has made you think differently about today's economy, share your thoughts. Are we wiser now, or are we just walking the same path in better suits? Your perspective is important because history is not over, it is repeating itself in slow motion. To truly grasp our current predicament, we must acknowledge a critical new variable: the digital accelerant. The core human emotions driving booms and busts, greed and fear, are timeless, but the infrastructure through which they now operate is fundamentally different. In the 1920s, information and panic traveled at the speed of telegraphs and newspapers. Today, they move at the speed of light. Algorithmic trading systems, which account for the vast majority of market activity, can trigger cascading sell offs in microseconds, long before any human has had time to process the news. This is not just a quantitative change, it is a qualitative one. It removes the possibility of thoughtful intervention, replacing it with automated reflexive contagion. The very concept of a market closing to allow for a cooling off period becomes almost quaint when financial sentiment can be reshaped globally overnight through social media. This digital amplification extends beyond the trading floor. The modern speculative bubble is also a social phenomenon, nurtured in the echo chambers of online forums and influencer driven hype cycles. In 1929, an investor might get a stock tip from a colleague or a broker. Today, millions can be drawn into a risky asset by a single viral video or meme, often with little understanding of the underlying value. This democratizes speculation, but also concentrates risk, creating flash mobs of capital that can inflate and then pop bubbles with unprecedented speed. The fear of missing out has been weaponized by algorithms designed to maximize engagement, pushing narratives of effortless wealth and creating a collective detachment from financial reality. Consequently, when the tide turns, the psychological impact will be just as amplified. The anger and disillusionment will not be confined to letters to the editor. They will fuel global online movements, spreading narratives of blame and betrayal instantaneously. This brings us to the most unsettling modern parallel: the fragility of the social contract. A financial collapse today would not occur in a vacuum. It would strike societies already grappling with deep political polarization, widespread misinformation, and a profound erosion of trust in institutions from governments and media to science and medicine. The economic pain of the Great Depression provided fertile ground for extremist ideologies. The economic pain of a future crisis could ignite a world already saturated with digital accelerants for social unrest. The blame would be assigned and amplified in real time, potentially fracturing societies along pre existing fault lines. In this environment, the sober, collaborative policymaking required to navigate a crisis becomes nearly impossible. The lesson, then, is a chilling one. While we have built more sophisticated financial instruments and regulatory bodies since 1929, we have also built a far more efficient engine for human panic and social division. The interconnectedness that defines our modern world financially, technologically, and socially means that there are no firewalls. The very tools we celebrate for bringing us closer together may, in a crisis, become the mechanisms that tear everything apart with a speed and ferocity that the generation of 1929 could never have imagined.